Right now, everyday living expenses are completely out of control. We're watching gas prices push incredible highs, and we're dealing with unresolved conflicts across the Middle East that keep pressure on the global economy. Yet, if you look at the stock market, none of that seems to matter. Over the last year, the S&P 500 has surged roughly 30% higher. Valuations are running so hot right now that the Buffett Indicator, Warren Buffett's preferred metric for measuring total stock market value against the size of the actual economy, is sitting 2.4 deviations above its historical trend. And that rally is highly concentrated at the very top. Today, just 10 individual companies make up roughly 40% of the entire S&P 500 index. When you place the pain of the real economy right next to a market hitting all-time highs, the math feels broken. This is a leading suspicion that we've entered a feedback loop, where prices keep rising simply because they're already rising, the hallmark of a financial bubble nearing its peak. This is a line chart tracking the stock market of the 1920s leading into the Great Depression, overlaid with the last 30 years of our current market. As you can see, the two curves trace a nearly identical upward path. We see the exact same pattern if we look at Japan's everything bubble. Throughout the 1970s and 80s, extremely cheap interest rates flooded their economy with inexpensive money. People borrowed against their physical land to buy more stocks, driving a massive exponential rally that perfectly maps onto the S&P 500 today. But we know exactly how those historical rallies end. This is what it looked like outside the New York Exchange in 1929, when the music finally stopped and millions of people realized their wealth was gone. When Japan's market eventually popped in 1989, stocks plummeted by 50%. Their entire economy stalled, shrinking the workforce and leaving them unable to fully recover for the next 40 years. So we have to look closely at the data. Is our current stock market really built on the exact same fatal flaws that caused those historic crashes? Or is there an actual underlying logic driving prices this high? The core mathematical argument against the stock market right now is that share prices have completely detached from the actual money these companies are making. This bar chart compares stock prices relative to their expected earnings. For the last 100 years, the historical average has sat comfortably around 17. Today, the S&P 500's price-to-earnings forecast has spiked past 28. That means companies will either need to generate significantly more profit, or their share prices have to fall. We are also falling into the exact same demographic trap that triggered Japan's collapse. Since the 1950s, the number of adults having children has fallen sharply, leaving us with a shrinking pool of young workers tasked with funding increasingly expensive social programs. To keep those systems running, the government is forced to borrow heavily and spend far more than it collects. That burden eventually gets passed back to the taxpayer, forcing interest rates down and debt levels up just to keep the economy from stalling out. If you believe that economic facts dictate reality, the conclusion is straightforward. The entire system is falsely propped up. These extreme valuations are impossible to maintain, and the market must crash back down to its historical average. But markets rarely crash just because prices look high. Usually, it takes an unforeseen risk to trigger a massive cascade of selling. And right now, the companies driving this rally are generating massive amounts of cash. Back during the 2001 dot-com bubble, the average price-to-earnings peak hit 65, mostly driven by tech companies that didn't actually turn a profit. Today, the giants leading the index have cash flows that easily exceed their income, and net profits beating their own 5-year averages. A massive portion of that spending is going directly into artificial intelligence. Tech leadership views this as a literal existential arms race. Larry Page has explicitly stated he would rather see his company go bankrupt than lose the AI race. If they win, AI acts as an effective growth multiplier. Smaller companies, healthcare systems, and massive utility providers will use it to aggressively scale their operations and boost productivity without needing to expand their workforce. This area chart reveals the real penalty for sitting out the rally. If you kept your wealth in cash over the last 20 years, you lost an average of 1.8% of your purchasing power every single year. This creates a brutal paradox for anyone trying to build wealth. You are forced to buy into a stock market that looks completely irrational because the only other option is watching inflation guarantee the evaporation of your money. A lot of people try to resolve this paradox by claiming the stock market isn't actually gaining value at all. Instead, they argue the government printed so much money that the US dollar is simply crashing in value. This dual-axis line chart maps the M2 money supply directly against S&P 500 returns over the last 50 years. When you actually run the numbers, the correlation between the two is just 0.15. Statistically, that is essentially zero. Research shows global stocks went at 76% of the time, regardless of whether the dollar was rising or falling. It turns out that interest rates and broad investor enthusiasm drive stock prices far more than the raw volume of fiat currency sitting in the system. This means inflation alone cannot explain the current rally. These gains are fueled by a mix of investor psychology and systemic factors that go far deeper than the raw volume of currency in circulation. These psychological pressures are often enough to break even the most disciplined strategies. In finance, there's a sobering reminder. The market can remain irrational far longer than you can remain solvent. Take Isaac Newton. During the South Sea bubble of 1720, he looked at the math, realized the market was completely unsustainable, and correctly identified the bubble early on, so he pulled his money out. But then he had to sit back and watch all his friends get insanely rich. The fear of missing out pushed him to buy back in right at the absolute peak. And when the crash finally hit, one of the smartest men in human history lost his entire fortune. The best defensive strategy against that behavior is holding a 20% cash buffer in steady assets like treasuries. It gives you the cushion you need to weather a sudden 30 or 50% crash without panicking and selling at the absolute bottom. Predicting the exact day an irrational system will peak is a fool's errand. The only mathematically and psychologically sound method for surviving this disconnect is completely blind, relentless dollar cost averaging into the market, no matter